Welcome to the deep dive. Today, we're going to tackle something really interesting. We're looking at how money is moving around the globe, capital flows, and specifically how that's hitting the United States.
Right. And we're using the Citi GPS report Invest USA as our guide. It came out just this May 2025.
Invest USA, the reshaping of global capital flows. Sounds pretty comprehensive.
It really is. It pulls together insights from Citi's economists, executives, gives us a snapshot of foreign direct investment, FDI, coming into the U.S. right now, and looks ahead too.
And there's a forward too, right? From Sunil Garg.
Yeah, he emphasizes how vital FDI is for global trade and how it's, a long-term game. It sticks around.
Okay, so our mission today for you listening is to get a clear picture of the big trends in FDI coming into the U.S. What's driving it? What does it mean globally?
And we want to do that without drowning you in data. Keep it understandable.
Definitely. So maybe start with a bit of context, something surprising.
Well, think about this. Global trade in 2024 was estimated at around $33 trillion.
Wow, $33 trillion.
Yeah.
That's huge.
It is, and that's the backdrop for all this FDI movement we're talking about. It's happening within this massive global marketplace.
Okay, so let's get into what the report actually says. The big headline seems to be the U.S. is number one.
That's right. In 2023, the U.S. topped the charts for global FDI inflows, pulled in $311 billion.
$311 billion, that's a lot of investment.
It is, and what's really interesting is the growth rate. For North America, mostly the U.S., FDI jumped 13% in 2024 compared to 2023.
13%, while other places saw declines.
Exactly. Most other regions saw FDI go down. And the U.S. also had the highest growth in what they call greenfield projects.
Greenfield?
Yeah.
Right, remind us what that means.
Greenfield is like starting fresh, building a new factory, a new office, not just buying an existing company.
So new operations, often new jobs?
Precisely. It signals a deeper commitment. Usually.
Got it. And it's not just money coming in. We're investing abroad, too.
Yeah, the U.S. was also the biggest investor in other countries in 2023. So it's a two-way street, a major global player in both directions.
Okay, let's talk trade balance for a second. The report mentions the trade deficit.
February 2025, it was about $122.7 million. Down a bit from January, but still significant.
And who are the main countries involved in that deficit?
Primarily China, Mexico, Vietnam. We're buying more from them. On the flip side, we had surpluses with the Netherlands, Australia, Singapore, selling more to them.
So it connects to FDI how? These relationships are complex, right?
Absolutely. It shows it's not just about buying and selling goods. There's this whole layer of investment flowing between these same countries.
Now, here's something I found really striking. The shift since the pandemic.
Oh, yeah, that's a big one.
The U.S. share of global FDI went from, 15% up to 25%?
Yeah.
Overtaking the EU.
That's right. A really significant jump. It suggests a real change in where global capital sees opportunity or perhaps stability.
Why do you think that shift happened? What are the drivers?
Well, it's likely a mix. The U.S. economy has been relatively resilient. Plus it's a huge consumer market. And then there are geopolitical factors, companies wanting to diversify supply chains maybe away from other regions.
Makes sense. And where is this money going within the U.S. economy? Which sectors?
Manufacturing is the big winner. Since 2022, it's pulled in around $380 billion. That's like 42% of the total FDI.
Wow, 42% in manufacturing. A real focus on making things here again.
Seems like it, a definite trend.
And geographically. We often think California, right? Big economy.
Historically, yes. California gets the most total FDI stock. But interestingly, the growth rate of new investment there has actually been negative over the past decade.
Negative? Why?
The report suggests federal restrictions on investment from China might be a factor. Meanwhile, you see places like the Rust Belt getting a boost in manufacturing FDI.
A resurgence there.
Seems so. And just looking at 2023 alone, the New York tri-state area actually attracted the most new investment that year. So the picture is shifting a bit.
So a bit of a geographical reshuffle. What about those greenfield projects, the new builds? Where are they concentrated?
Over the last 10 years, nearly half of those announced greenfield projects were in just 5 states, and the dominant sector for those new ventures. Services.
Services, okay, like business services, tech.
Exactly. Software, IT, professional services, that kind of thing.
Let's talk jobs. That's always the big question with FDI.
Yeah.
Is it creating jobs here?
The numbers suggest yes. Nearly 2 million jobs either reshored or created by new FDI since 2010.
2 million, that's substantial.
It is. It's about 40% of the jobs that had previously moved offshore, according to the report's estimate.
And which country's investments create the most jobs?
Since 2014, Canada and the UK are the leaders there responsible for over 2 million jobs combined. Europe overall accounts for almost half, about 46% of all FDI-linked employment in the US.
That's a huge impact.
Yeah.
What about revenue? These foreign-owned companies must be generating significant income.
Absolutely. Over the last decade, these new FDI affiliates generated $1.35 trillion in total revenues.
1.35 trillion.
Yeah. And again, California and Texas come out on top as beneficiaries, both in revenue and the number of jobs created by these firms.
Beyond jobs and revenue, what about innovation? Does FDI bring new ideas, new tech?
That's a key aspect. The report points to the high quality of patent filings in the U.S., especially in areas like electronics, manufacturing tech, but also health tech, industrial services. It suggests these investing companies are really grabbing R&D here.
And speaking of cutting edge, AI comes up, right?
Big time. The U.S. is really dominant in AI investment right now. In 2024, it apparently grabbed over half of all global VC deals in AI and machine learning.
Over 50%.
Yeah, and that investment is still growing strong here. While it seems to be plateauing a bit in Europe and Asia, it really highlights the U.S. lead in this critical field.
Okay, that gives us a great overview of the data. Now, the big question,
Yeah.
this America First idea, how does that potentially shape this FDI landscape? The report talks about net inbound FDI. What does that actually mean?
Right. Net inbound FDI is basically the foreign money coming in minus the U.S. money going out to invest elsewhere. It's the overall balance.
Got it. And FDI isn't just one thing, is it? We mentioned Greenfield.
Exactly. Greenfield is building new. The other main type is acquiring a big chunk, a significant stake in an existing U.S. company. That brings financing, maybe helps competitiveness. Both are forms of equity FDI, taking an ownership piece.
Are there other kinds?
Yes. There's also reinvested profits money earned here by foreign firms that they put back into their U.S. operations. And intercompany lending, basically loans within the same multinational firm. These can fluctuate more, but the overall FDI number tends to be pretty stable.
So why do companies invest abroad? We know tariffs might push them to produce locally, but what are the other big reasons beyond just avoiding tariffs?
Oh, definitely. Access to the massive U.S. market is still probably number one, but also cost efficiencies, maybe cheaper energy, skilled labor, accessing specific expertise or resources you can't get at home.
And supply chains.
Huge factor now. Diversifying supply chains, making them more resilient. And just simplifying things, reducing cross-border friction, transport costs, regulatory hurdles.
Are there downsides? Things that make companies hesitate?
Sure. Managing global operations is complex. There's a risk of, diluting your special know-how and sometimes political pressure back home to keep jobs there.
Okay, let's zoom out globally again. What's the big picture trend for FDI worldwide?
Well, over the last, say, 25 years, global FDI has averaged about $1.5 trillion a year. But as a share of global GDP, it's actually dipped a bit since 2018. It's now around 1.5%, down from maybe over 2% before.
So a slight slowdown relative to the overall economy.
Kind of suggests that, yeah. Maybe a bit less traditional globalization, or at least a change in its form.
And how do Europe and China compare to the U.S. recently?
So before the pandemic, the EU often got more FDI than the U.S., but that's flipped. The U.S. is ahead now. Both the EU and China have seen FDI inflows decline recently.
Why the decline there?
For the EU, probably weaker economic demand, energy worries, the whole Russia-Ukraine situation. For China, it seems more about geopolitical tensions, companies rethinking supply chains, like we said, reallocating, not necessarily a full retreat from globalization.
The report mentions FDI positions, too. If those are the river, what are positions?
Good analogy. Positions are the total stock of investment, all the accumulated foreign-owned assets in a country at a specific time. Globally, that was about $50 trillion at the end of 2023.
50 trillion. And the big players hold most of it.
Yep. The US, EU, and China account for about 60% of that total. Interestingly, some smaller financial centers like Luxembourg also have huge positions relative to their economy size.
What about investor confidence? Where do executives see future opportunities? The FDI Confidence Index.
Right, the Kearney Index. It surveys execs. Early 2024, the top 5 were US, Canada, China, UK, Germany. Pretty stable rankings since 2018, actually.
What factors are driving those rankings?
Things like tech and innovation leadership, the legal and regulatory climate, how easily capital can move, supply chain risks, access to resources. The usual suspects, but weighted differently maybe.
Okay, back to the U.S. breakdown. Manufacturing leads flows since 2022. What else is big?
After manufacturing's 42%, you've got wholesale and retail trade combined at about 19%, then financial services around 12%. And within manufacturing, chemicals, especially pharma, is a key subsector drawing investment.
And where is this investment coming from? We know the EU is big.
Yeah, looking at the total stock, the FDI positions by country origin in 2023, the EU holds almost 45%. Japan is next at nearly 13%, then Canada just over 12%, UK around 12%.
What about China?
Much smaller share, only 0.5%. That's down from maybe 1% a decade ago. Likely those geopolitical factors again. And a lot also comes via offshore financial centers, making the ultimate source sometimes harder to track.
And state-by-state flows for 2023. Where did the money land?
California was #1 in gross flows, then New Jersey, Texas, New York. But like we said, California's share, while top, is lower than its historical average. New Jersey's share actually increased.
So summing up the drivers for the U.S. strength right now, what's the core recipe?
It seems to be a few key ingredients. Strong relative economic performance. Cheap, abundant natural gas, which is a big plus for manufacturing and chemicals. Leadership in AI is a massive magnet.
Plus the global shifts.
Right, the rebalancing away from China for some supply chains. And U.S. policy things like the CHIPS Act, the IRA, encouraging domestic production. You see it in the jump in manufacturing construction spending.
Looking forward, is the optimism high? What are the risks?
The outlook seems generally positive, but it hinges on, continued U.S. economic outperformance, those low gas prices holding, the reshoring trend continuing, and keeping the lead in AI.
But potential headwinds.
Policy uncertainty is a big one. Future tariff changes, maybe shifts after the 2028 election. Those create risks. On the other hand, you could see new policies to boost domestic investment, further talk of sovereign wealth funds, more tax breaks, things like that.
Okay, let's switch to financing all this.
Yeah.
How do companies actually pay for these big FDI projects? The report says it's about growth versus cost reduction.
Yeah, fundamentally, companies invest abroad for one of two main reasons, or often a mix. Either to tap new markets for future growth or to lower their costs, cheaper labor, energy, materials. They'll run the numbers, maybe do an NPV analysis to see which path makes more sense. Cost efficiency is often still a really big driver.
And how does the fourth industrial revolution, Industry 4.0, play into this?
That's changing the game. All the digital tech, AI, IoT, robotics, it makes automation much more feasible. That can make labor costs less critical in deciding where to build a factory. It potentially opens up manufacturing FDI in places that weren't viable before.
And it's not just factories, right?
Yeah.
Services, too.
Absolutely. Lots of FDI goes into service businesses or the service parts of manufacturers. Think about those follow-the-sun models, where companies operate across time zones that often requires FDI.
So the nuts and bolts of financing. The report mentions 5 stages.
Right. It breaks it down. Pre-development planning, then development, operations commence, operations sustain, and finally future development or starting the cycle again.
And different financial tools fit each stage.
Exactly. Early on in planning, it's about feasibility funding. During development, building things out, you might use payables finance for suppliers or trade and working capital loans.
And once things are up and running.
When operations commence, letters of credit become important for managing risk with new international customers or suppliers. In the sustain phase, managing cash flow is key, maybe using export agency finance for longer-term needs. It's about matching the right tool to the right stage.
There's a quote in there from Ernesto Torres Cantu at Citi. That was his main point.
He basically reinforced that the U.S. is highly sought after. Strong fundamentals, world's biggest economy, top FDI recipient, plus this current focus on bringing investment onshore, it all makes the U.S. attractive.
The report also mentions family offices becoming more important investors.
Yeah, Hannes Hoffman from Citi highlighted that. Family-owned business wealth is growing fast, might manage more assets than hedge funds by 2030, and most of them invest internationally, including FDI in the U.S., often things like real estate.
But it's complex for them.
It can be. Managing global investments, different regulations, it adds layers of complexity.
What about the view from the commercial banking side? Tasnim Jawadwala.
She stressed that despite global volatility, the U.S. is still a key market for their clients. The big focus is operational resilience innovation, fixing supply chains, nearshoring, onshoring.
So companies are acting.
They are, though maybe cautiously on huge changes, a bit of wait and see. But the expectation is definitely more manufacturing, more production in the U.S., made in America. It remains the #1 target for future expansion because it's dynamic and people buy things here.
Does Citi Commercial Bank see specific state-level trends?
Yeah, they echo some of what we discussed. NorCal for tech logistics, MassNJ for healthcare pharma, South Midwest for digital tech, Texas South for manufacturing, Northeast for financial professional services.
And the big states get a lot of the initial spending.
Right. California, New Jersey, Texas got about 24% of the first-year spending in 2023, especially in transport, warehousing, and manufacturing. Greenfield projects show similar geographic patterns.
What about smaller companies trying to come to the U.S., emerging growth firms?
They face unique hurdles. Building a reputation from scratch, competing in a crowded market, getting access to credit, managing treasury efficiently,
Yeah.
often with smaller finance teams. That's where having a global bank with local know-how really helps.
And the hot sector's attracting FDI overall. Quick recap.
Tech, heavily in California. Manufacturing and auto, strong in the Midwest and Southeast. Business professional services, mostly Northeast. And healthcare biotech in hubs like Massachusetts, NJ, California.
So final advice from Citi Commercial to clients eyeing the U.S.
Key things are: understand how integrated the market is, navigate the cultural diversity, know the wide range of financing options, VC, IPOs, debt, and manage the dynamic treasury side, like currency hedging and payments. They also talked about their role in connecting investment corridors into the U.S. from key regions globally.
Okay, so let's try to wrap this deep dive up. The big picture from the Citi report seems clear. The U.S. is really leading the pack in attracting FTI right now.
Definitely. Driven by its own economic strength, but also these big global shifts, supply chain rethinks.
And things like America First policies are adding another layer, creating a really dynamic, evolving picture. Plus, there are sophisticated ways to finance these moves.
Exactly. So understanding these changes, these flows, is pretty crucial if you're in global business or investing, or frankly, if you just want to get a handle on the forces shaping the global economy.
Right, so maybe a final thought for everyone listening to mull over. With this drive for domestic production, potential policy shifts down the road,
Yeah.
what kind of long-term strategies do multinational companies need? How do they thrive in this changing world?
Yeah, and could we see totally new business models emerge? Maybe focus much more on regional production or even hyper-local. It's definitely something worth thinking about.
Absolutely. Well, that's all the time we have for this deep dive. Thanks for joining us.